Well, let's get straight to Standard Glass Lining Tech. We do have with us the MD of the company, Nageswara Rao Kandula. Remember, it's an IPO that opens today. 410 crore rupee issue, of which 200 crores is an OFS, 210 crores a fresh issue. The issue has been entirely subscribed in the first 20 minutes of being launched itself. 133 to 140 rupees per share is the price of the company in terms of an offering. Let's discuss the business plan with them. Mr. Paturi, thank you so much for joining in. Mr. Kandula as well. Just wanted to understand first up, what portion of the Capex set up for pharma and chemicals do your products account for? If you could, give us a revenue breakup in terms of sectors, and at the same time, give us a sustainable revenue run rate, because it's been all over the place. If you look at it, over the last few years, some years it's actually doubled, some year it's declined. If you could give us what a sustainable revenue growth path for your business would look like.
Thank you. Thank you for the opportunity. Total opportunity India, total pharma and chemical opportunity is almost 40,000 crores. Engineering opportunity is there. And if you remove the civil part, 20%, 30,000 crores opportunity is there. Today we are doing only 2 to 2.5% revenue based on that 30,000 crores versus our revenue. 97% scope is there. And the last 5 years, we are maintaining the CAGR 25% growth. And coming 10 years, we are going to maintain the same growth.
Okay, all right. Hi, Mr. Kandula, as well as Mr. Paturi. Well, I had a quick query. I'm looking at some of a peer set, which includes GMM Pfaudler, as well as HLE Glasscore. And they have clearly been struggling. You're a little bit smaller. So on that smaller base, it appears you're growing faster. Is there any other reason why their growth is not as much, but you're growing so well? As you said, last few years, CAGR has been quite good.
No, we are not, compared to their figures, we are not smaller. If you look into the standalone revenue, compared to their GMM Pfaudler is 50% revenue coming from heavy engineering and 50% is only equipment. HLE also a size of 500 crores domestic standalone revenue. If you look into this year, we are going to 10 years, 11 years old company. We are going to touch this year 650, 670 crores revenue. We are slow. Next to 25 financial, we are becoming number one. And our growth is, both are not our competitors, honestly. Okay. Why? They are limited product range. We have full basket. We are complete equipment we are manufacturing. 65 variety of products we are manufacturing, and we are doing complete turnkey projects. Not only equipment, loose equipment supplied, we are customized equipment supplied, we are service sector, and also we are complete plants we are building. Recently, we completed one turnkey project for Dr. Reddy's. One project we completed, Cohen's project we completed. All top clients
are now. So got it, sir. So what you're telling us is that it's not a like-to-like comparison, yes, with regard to these two competitors. So you're not like to compare yourself because your product mix itself is a little different. We take that on board. And as you said, towards the end of this year, you could do anything between 650 to 700 crores. What kind of utilization levels? What is it, sir?
650 to 670 crores we are going to touch.
650. Got it. So what utilizations levels would that be, in terms of your current capacity? What would it be, 650 crores?
650 crores. Recently, we added one more facility. Now we have 9 facilities. These 9 facilities dedicated to pharma and chemical equipment manufacturing. Yeah. This we are bringing new technology, robots and automatic polishing machines and automatic welding machines, and we started this all implementation. Coming 2 months, we are going to implement another 40 crores Capex we are going to do in the existing facilities. Another 60 crores we have planned. Total 100 crores we are going to complete in coming 2 years. But within 6 months, we are going to complete first phase 40 crores. Based on that, this upgradation of the all facilities, our revenue can increase up to threefold.
Okay, revenue from current capacity and the Capex that you're doing can increase threefold is what you're saying.
Yes.
And basis your 25% CAGR guidance that you've given for the next 10 years, it appears that you can actually, increase your revenue by 2x in the next 3.5 years, and maybe threefold in the next 4.5 years. Is that a fair estimate?
Fair estimate, yes. 20-25% we are targeting. But also, we industry growth is single digit, but today India have 6,000 clients. Standard
Right.
glass only 800 clients, and recently we IPP USA worldwide
Right.
1,50,000 clients are there. We signed agreement. We are our export also. This year we are going to touch 15%. Next year we are going to touch 20%. Our export revenue also increasing day by day, year
Okay.
on year.
So exports will become 20% from 15% this year. Just wanted to understand two things from you. Mr. Kandula, while on the top line, things are looking extremely great. You are talking about great growth over going forward as well. It is not reflecting in your cash flow from operations. If I look at it, your FY22 cash flow from operations was negative 7 crores. FY23, it was just 1.7 crores. FY25, it declined. It was minus 65 crores. So if you could give us a sense on what kind of EBITDA margins and cash flow from operations can you generate over the next couple of years?
Cash flow negative is all are aware this pharma and agrochemicals is facing last 2 years stress mode, and the receivables is getting delay, and also meanwhile we started turnkey projects and also upfront equipment ready-made deliveries. This all little bit affected, but now last 6 months improved and we received some receivables. Maybe next coming 6 months cash flow going to positive, and profitability going to a slightly this year we are going to touch 15% export sales. So our profitability going to slightly this year we are going to increase, maybe 12 to 13% increase, profitability going to increase, and EBITDA margins going to touch 20%. Our profitability and EBITDA is main coming from export sales.
Okay, all right. Just a quick query. So your operating cash flows turn positive in the coming fiscal, right? That's what you're telling us.
Yes.
And margins are sustainable at around this 20% odd mark because it's improved
Yes.
in the last few years from mid-teens to 20%. It's sustainable.
Yes.
Got it. And final question. Yeah.
Future is we are increasing. The major focus is domestic is margins are very tight position situation now today, and export margins are very high. Even our investor AGI, our investor Japan, they have 12% stake. They are in board, and they are also started giving orders. We are going to export to next coming 2 months.
So there's a potential for margins to improve, sir. Is that correct?
Yes.
Potential margin. Finally, your ROC and ROE, they have seen a sharp fall in the last 2 years. What kind of targets you have on both these two ratios?
Due to Japanese investment, that investment 170 crores they invested. After that investment, this ROI gone down. But now we are increasing our sales, and it will coming back within coming 15 months. It coming to back. Whatever earlier is there, same level it will come.
Okay, we'll take that point. Thank you so much for joining in and giving us a brief primer into your business. But Mr. Kandula, we'll leave you with a promise that you join us on the listing day and give us a lot more details about the growth plan for your business, and at the same time address issues of receivables, cash flow, as well as return on equity and return on capital employed ratio improvements going forward as well. For now, good luck with the issue so far.